1%. That's all Tyler's financial advisor charges. Barely a rounding error. Feels like nothing. That 1% just cost Tyler $340,000 over the life of his portfolio, and he thanked the guy for it. Turns out almost everything you think you know about investing is wrong. And I'm not talking about minor technicalities. I'm talking about myths with a dollar sign attached to them. Myths that are actively draining your net worth while you think you're being smart. In this video, I'm breaking down 13 investing myths you probably still believe, with the real math on what each one is costing you. And the last one, it's the most expensive lie in all of personal finance. Let's get into it. Myth 1, or a 1% advisor fee, is barely anything. This is the myth that kicks off everything because it sounds so reasonable. 1%. A single penny out of every dollar. Your advisor probably told you it was standard, and you believed it because why wouldn't you? But let's run the numbers Tyler didn't. Say Tyler has a $200,000 portfolio. It grows at 8% per year over 30 years. Without that 1% fee, his portfolio lands at roughly $2 million. With the fee growing at 7% instead, he ends up at about $1.5 million. That 1% didn't cost him 1%. It cost him roughly $500,000. And here's the part that makes it worse. You're not paying 1% once. You're paying 1% every single year on a growing balance. The fee compounds against you with the exact same force that returns compound for you. It's a silent, invisible drag that you never see on a single statement. But it shows up at the end when $500,000 is missing from your retirement. Tyler thought he was paying for expertise. He was paying for a handshake and a quarterly email. But at least his advisor is picking the right stocks for him. Right? Myth 2. Picking stocks is how you get rich. This is the myth that sells every investing app, every stock newsletter, every YouTube thumbnail with a green arrow going up. The idea that if you're smart enough, do enough research and find the right picks, you'll beat the market. Except over a 15-year period, roughly 90% of actively managed funds, run by professionals with research teams, PhDs, and billion-dollar budgets, underperform the S&P 500. 90%. These people do this for a living and they still lose to a basic index fund that does literally nothing. And the fees on those actively managed funds make it even worse. You're paying more money to get worse results. It's like hiring a personal chef who burns your dinner and charges you double. If the professionals with every possible advantage can't consistently beat the market, what makes Tyler think his Reddit research at midnight is going to? Okay, so if picking stocks doesn't work, at least the market rewards you for taking bigger risks. Myth 3. Higher risk always means higher reward. This is the one people repeat without ever questioning it. More risk, more reward. Go big or go home. Tell that to every penny stock investor who lost everything. Every leveraged ETF holder who watched their position decay to nothing over time. Every meme coin buyer who's sitting on a 95% loss right now. Risk and return are correlated up to a point. Past that point, you're not investing. You're gambling. And the house has better odds. The highest long-term returns in market history came from the most boring investments imaginable. Not moonshots, not 10x plays, index funds. And Tyler scrolled right past them. But surely if Tyler just buys at the right time? Myth. 4. Timing the market beats. Time in the market. Buy low, sell high, wait for the dip. It's so simple it has to work. Here's what actually happens. If you invested $10,000 in the S&P 500 over 20 years but missed just the 10 best trading days, 10 days out of roughly 5,000, your returns get cut by nearly half. Miss the 20 best days and you barely beat inflation. And here's the kicker that makes this almost cruel. Most of those best days happen immediately after the worst days. The market drops 30% and the next week has 2 of the best days of the entire decade. Sell during the crash and you almost guarantee you miss the recovery. Nobody can time this consistently. Not hedge funds, not algorithms, not the guy on CNBC with the sound effects. The data on this is overwhelming. Dollar cost averaging into the market consistently beats trying to time your entries. Let me make this concrete. 2 people, Tyler and Sarah, both have $10,000 to invest in the year 2000. Right before the dot-com crash. Tyler panics, pulls out, waits for the right time, and keeps waiting. Sarah does nothing. She doesn't even look at her portfolio. She just leaves it alone. By 2020, Sarah's $10,000 has grown to over $30,000 even after two of the worst crashes in modern history. Tyler, he jumped back in around 2013 after feeling confident again. His $10,000 became about $17,000. Same starting amount, same market. Tyler's smart timing cost him $13,000. Sarah's strategy? She literally did nothing. Tyler spent years trying to outsmart the market. The market didn't even notice. And when the market finally does crash, everybody knows what to do. Right? Myth 5. A market crash means you should sell. The market's tanking. Everything's red. The news says it's going lower. Every instinct in your body screams, get out before it gets worse. The 2008 crash, S&P 500, dropped roughly 57%. It recovered fully by about 2013. The COVID crash, market dropped 34% in March 2020. It recovered in approximately 5 months. Every single major crash in market history was followed by a recovery that eventually surpassed the previous peak. Every single one. The people who lost the most in every crash weren't the ones who held. They were the ones who sold at the bottom and locked in their losses permanently. A crash isn't a funeral. It's a clearance sale. And Tyler just returned his merchandise at 60% off. Speaking of things that aren't the safe bet everyone thinks, Myth 6. Real estate always goes up. You can't go wrong with real estate. It always appreciates. It's the safest investment there is. You've heard this 1,000 times. Your parents said it. Your coworkers said it. Everybody says it. Adjusted for inflation, the average home appreciates roughly 1% per year. 1. The S&P 500 averages roughly 7% after inflation, but Tyler never hears that comparison because nobody selling a house wants you to hear it. And appreciation is only half the lie. Let's talk about what Tyler's investment is actually costing him every single year. Property taxes. 1 to 2% of the home's value. Homeowner's insurance. Maintenance and repairs. The general rule is 1% of the home's value per year just to keep it standing. HOA fees if applicable. And when Tyler eventually sells, closing costs eat another 5 to 6% of the sale price. So his home appreciated 1% per year, but the carrying costs ate 2 to 4%. In a lot of cases, Tyler's home isn't making him money. It's quietly losing it while he brags about the Zillow estimate. And the people who say real estate. Always goes up, conveniently forgot 2008. Home values dropped over 30% in some markets and took a full decade to recover. Always goes up cost millions of people their retirement plans. Now, I'm not anti-real estate. Rental properties, REITs, strategic real estate investing, that can absolutely work. But my primary home is my best investment is a myth that needs to die. Your home is a great place to live. It's usually a mediocre place to invest. Tyler just confused the two. But at least dividends are guaranteed income. Free money, basically. Myth 7. Dividend stocks are free money. Dividends are passive income on top of your returns. It's literally free money deposited straight into your account. That's how Tyler sees it. That's how a lot of people see it. And it's wrong. On the ex-dividend date, a stock's price drops by approximately the dividend amount. So if a stock pays a $2 dividend, the share price drops by roughly $2. You didn't earn $2. Your investment just moved $2 from your left pocket to your right pocket. It's your own money being handed back to you. And in a taxable account, you might owe taxes on it too. Total return, price growth plus dividends combined, is all that matters. And many dividend-heavy portfolios underperform growth portfolios over time because those companies are returning cash instead of reinvesting in growth. Tyler got a $500 dividend payment and celebrated. His portfolio dropped $500 that same day, but the notification felt nice. Now, none of this matters if you don't have money to invest, right? Because you need a lot to even start. Myth 8. You need a lot of money to start investing. This is the myth that keeps the most people on the sidelines. Investing is for people who already have money. I'll start when I make more. There's no point investing small amounts. $100 a month at 10% average annual return for 30 years equals roughly $226,000. $200 a month? $452,000. And with fractional shares, you can buy into the S&P 500 for literally $1 on most platforms today. The barrier to entry is gone. It's been gone for years. But here's the part that should keep Tyler up at night. The biggest cost of this myth isn't the money you don't invest. It's the time you waste. Compound interest needs time more than it needs size. Every year you sit on the sidelines isn't just $1,200 lost. It's what that $1,200 would have become over 20, 30, 40 years. $100 a month. That's the price of giving up. And Tyler's been paying it for 5 years without realizing. And on the topic of time, Myth 9, you're too young to start. Or too old. This myth works in both directions. Young people think they have forever, so they wait. Older people think the ship has sailed, so they never board. Both are dead wrong, and the math proves it. Here's the cost of waiting. $300 a month invested from age 25 to 65 at 8% annual return equals roughly $1.05 million. The same $300 starting at 35? About $440,000. 10 years of delay didn't cost Tyler 25% of his returns. It cost him over half. 10 years of "I'll start later" erased $600,000. That's not a rounding error. That's a house. But too old is equally destructive. Say Tyler is 45. He figures the window's closed. Why bother? Here's why. $500 a month from 45 to 65 at 8% is roughly $295,000. That's almost $300,000 that didn't exist before. From money Tyler was going to spend on things he wouldn't remember in 2 years. Even at 50, it's not over. $500 a month for 15 years at 8% is roughly $173,000. That's the difference between a retirement where you're comfortable and one where you're counting every dollar. There is no age where the answer is don't bother. There's only the cost of waiting another year. And that cost goes up every single day. The best time to start was yesterday. The second best time is before this video ends. So Tyler finally starts investing. And his first move is an index fund. Boring. Myth 10. Index funds are just average. Index funds just give you average returns. Why would you settle for average when you could do better? Because that average return has beaten roughly 90% of professional fund managers over 15 plus years. Being average in the stock market literally puts you in the top 10% of all investors. Let that sink in. Warren Buffett bet $1 million that a simple S&P 500 index fund would beat a hand-picked collection of hedge funds over 10 years. He won. And it wasn't close. Average is the cheat code. You just have to be boring enough to use it. And Tyler isn't boring enough, which is exactly why he's losing, but at least Tyler's portfolio is diversified. Myth 11. Diversification means owning lots of stocks. Tyler owns 30 stocks and thinks he's diversified. He's got Apple, Google, Amazon, Microsoft, Netflix, Tesla, Nvidia, 30 companies, 30 different tickers. He's covered, except in the dot-com crash. The NASDAQ dropped 78%. Those 30 different stocks, they all did the same thing. Collapse. Because they were all in the same sector, driven by the same forces and exposed to the same risks. Tyler had 30 stocks, but one single bet. He just didn't know it. Real diversification isn't about how many stocks you own. It's about variety across asset classes. Domestic stocks, international stocks, bonds, REITs. If everything in your portfolio moves in the same direction at the same time, you're not diversified. You're concentrated with extra steps. And speaking of false safety nets, Myth 12. Gold is always a safe investment. When everything else fails, gold holds its value. It's the ultimate safe haven. That's the pitch. Gold's inflation-adjusted return over the last 50 years, roughly 1 to 2% annually. The S&P 500 over the same period, roughly 7%. and gold went essentially flat from 1980 to 2005. That's 25 years of basically zero real returns while the stock market grew over 1,000%. Gold has a place. A small one. Maybe 5 to 10% of a portfolio as a hedge. But as a primary investment strategy, it's a wealth preserver at best and a wealth killer at worst. Gold doesn't build wealth, it just looks like it should. But now for the biggest myth of all, the one that ties everything together. Myth 13. Pay off all debt before you invest. This is the big one. The myth that sounds the most responsible. The one your parents told you. The one that feels right in your gut. Pay off your debt first, then invest. Tyler has $20,000 in student loans at 4% interest. He decides to throw an extra $500 a month at the debt. In about 3 years, he's debt-free. Feels incredible. Feels like the smart move. But let's follow those $500 down 2 different paths. Path 1, Tyler's path. He puts every extra dollar toward the loan. In 3 years, the debt is gone. Then he starts investing that same $500 a month. After 30 years total, he ends up with roughly $680,000 in investments. Not bad. He feels smart. Path 2, same $500 a month, but instead of attacking the loan, Tyler invests it from day one and makes minimum payments on the 4% debt. The loan takes a bit longer to pay off, sure. But after those same 30 years, his investment portfolio sits at roughly $850,000. That's a $170,000 difference. Same income, same monthly amount. The only thing that changed was where the money went first. And that gap gets wider the longer you zoom out, because every dollar Tyler sent to the 4% loan is a dollar that missed years of compounding at 8%. The early dollars are the most powerful dollars. And Tyler spent his most powerful dollars killing cheap debt. This is what financial researchers call the difference between emotional math and actual math. Emotional math says all debt is dangerous. Kill it. Actual math says cheap debt below 5 or 6% is one of the most powerful financial tools you have. Your low interest debt is leverage. The instinct to destroy it feels responsible, but that instinct is costing you the very wealth you're trying to build. Now, important caveat. High interest debt, credit cards at 20% plus, kill that immediately. That math works in the other direction. But lumping all debt together as bad is the most expensive oversimplification in personal finance. The most expensive investing myth isn't any single one of these 13. It's believing all of them at the same time. Every myth Tyler believed had a dollar amount, and they were all compounding against him. 13 myths. If you believed even half of them, they've already cost you thousands. But here's the thing. Now you know. And knowledge compounds too. And if you think the investing world is full of lies, wait until you see what car dealerships are doing to you. Because the real investing myth is that it has to be complicated. If this changed how you think about investing, do me a favor. Hit that like button.